And now, look, without any further ado, I would like to hand over to Bill Withers, the founder of Adapt by Design and entrepreneurial legend. Over to you, Bill.
I always get intimidated by that introduction, but anyway, let's get into it. So, okay, so today we've, in this series, we've talking about resilient business, and we're talking to these 4 zones. So the zones we've done so far are healthy culture, economic engine, and today we're going to talk about financial security and ownership. But in actual fact, I don't have time to do much on ownership today. It's a very big topic, as is financial security. So we will be focusing well and truly on financial security. One thing I've discovered on doing this particular series is that it's very, very difficult to actually set the marker as to where you actually talk about this topic of resilient business, because depending upon whether I'm talking to a startup leader or I'm talking to an early stage SME or a more mature SME, and the experience of the leadership, it gets difficult. Today, the content is going to be more of a stretch, I think, because the nature of it, financial management and financial security, if it's just about the management of, the P&L and the transactions of the business and the basic regulatory sort of stuff is pretty, I mean, there is a million accountants out there that are supporting businesses to do that. I think what I got fascinated by was the intersection of what the entrepreneur is looking for as far as management accounting and the challenge of resilience, which is not only thinking about my financial security today, but also thinking about my organization's financial security for tomorrow. And so it's a mindset that's as much about sustainability of my organization as it is, the immediate term. So because of that, the content, I think, is going to be quite, it's pretty dense, but I'll do my best. Anyway, so the first thing that I wanted to bring up, and you're thinking he's just put up a book by a guy that worked with the All Blacks. And this guy, I haven't read this book, but I saw him present, and we were both presenting at the same conference actually. And he's a psychiatrist, but what he was doing was supporting the All Blacks in psychology. And in his book and in his talk, he talks about the red brain and the blue brain, and what we really need to do is have a purple brain. And what the red brain is more of your reptilian, that's your, not only your reptilian, but your emotional side, positive and negative, so both love and flight and fight live there. And the blue brain, this is my interpretation of it, is your mammalian brain. So that's the one where you're analytical and you can think slower, whereas the red brain is very fast. So the concept of the purple brain is to develop our capability so that we can integrate both of these two things so that we're not all emotional, but we don't also just want to be pure logisticians. So why am I talking about this? The reason I'm talking about this is that if you have to make decisions when you're in a high pressure situation and you've done no preparation for that, the probability is you'll make bad decisions. So with financial security, what I learned in my journey is the more preparation I can do for knowing that at some stage in the future, my business is going to get a shock, that the more that I did that thinking and set up infrastructure to deal with what would happen when I was under pressure, it made us be able to navigate those difficult situations and make better decisions. So that's my first point. I do throughout this talk, when I was talking about healthy culture, I was talking about, you know, what I'd been introduced to and learnt in leadership. And a lot of the science supports that creativity and being able to do high-end strategy requires people to be out of the antithesis of flight and fight. So if you're anxious or in fear or angry, you're actually your brain is actually in a state where it's very, very difficult to be creative and think big. So better to do it when you're cool and calm, and then have that on the shelf, ready to go for when things get tough. Okay, so let's get going here. So I think that the first thing I want to say is that there is a lot of, I've dealt with lots and lots of companies now, and I've had my own experience. And what I've noticed is that a lot of SME owners don't lean into this enough. I found that by leaning into this topic and really doing my best to understand the nuances of financial security, it had a very big and positive impact on my business. And so there's, I've seen a lot of organizations sort of abdicate the responsibility for this and almost say, okay, I've delegated that to the accountants, and as long as they do their job, everything will be fine. I think that might be okay if all you're trying to do is tick the box on the regulatory and compliance side of your business. But if you're trying to build something that is really robust, then you need to build a partnership. And that partnership is in finding leadership and leadership support for financial security in your business. Now, I think one of the best decisions I made in my entire journey was in 2003. Now, there's lots of good ones, and there's lots of fantastic people, and they're all important. Okay, it was just that for me, that this was a discovery. I mean, I understood hiring a great geoscientist. I understood hiring a good software engineer, but I didn't really understand what I would get by employing and hiring a financial security leader. So in 2003, I had 24 people in my business. I knew we were about to grow. All those 24 people, reported to me, for want of a better word. And so consequently, I was under a lot of pressure because we were about to grow. And I got to a ridiculous situation that was the first pull or second pull for us overseas. So we'd already had work going on in Africa, but now we were getting a lot of pull to go to Chile. And so I was in this stupid situation of actually trying to understand Chilean tax law prior to going in and demonstrating my technology to a resources company. And the absurdity of that situation was not lost on me. So I did a lot of planning and thinking, and I made the decision that I was going to hire a chartered accountant to look after all of our legal and financial risk, essentially, at that stage. Now, the hiring process was, I don't have time to go through it, but suffice to say that 87 people responded, and I interviewed the last 8, and the interviews went between 2 and 3 hours. And I was trying to find the person that I could see that was going to be a leader and actually be able to work with an entrepreneur to build the company. And this was incredibly successful. And I think that what I ultimately learned from this, and what the guy I hired was a guy called Dave Stephen. Dave Stephen was with me we were working together in Acquire for 11 years, and in Adapt. So Dave is still in Adapt. So we've been working for 6 years. So we've been together for 17 years. Now, what we did was he educated me in financial security and I educated him in entrepreneurship. And so we were able to end up, you know, I started to truly understand a chart of accounts and the why behind it. We started to build, and you're going to hear a lot more about this today, you know, forecasting systems and really effective ways of actually looking after the finance in our business. So what Dave and I developed was that there was five different areas in financial security. Now, how this came about is because one day I asked Dave, and we ended up having a very, very strong financial team because we were operating in so many different currencies. So we had 6 different legal and accounting jurisdictions, and then we had, you know, 8 currencies, and so we had transfer pricing. It was complex. So I got our 2 lead, Dave's as the leader or director of financial security, and one of our regional leaders at the time, got them in the room, and I said, what do you guys do? Now, they were sort of staggered by that question because they thought, well, you know, we've been working with you for a long time, Bill, and what do you mean, what do we do? And what I noticed is that they have a language that was not open to me. So for instance, you know, I would be thinking about working capital, right? And they would talk about treasury, you know, and all things that are associated with that. When they talk about, I would think about the ins and outs and the transactions, and I would call that, that's managing transactions. They'd call that accounts payable, accounts receivable. And what I started to do is I started to realize that they were operating in nouns and I wanted verbs. So we came up with these 5 areas of financial security. Manage the transactions. That's everything that goes in and out. Manage forecasting. Manage working capital. Manage your jurisdiction. So that's tax and regulatory. And report on business status. So we built our capabilities in finance around those 5 areas. And I think that this is a tip, you know, whenever you can, use verbs, not nouns, because verbs are about action. And it helps with good design. Anyway, I think that, you know, doing all of these 5 areas is what I think leads to supporting resilience, because, and I know it's demanding, and I know that a lot of owners are saying, man, look at my hats over there on the, you know, I've got so many different things to concern myself with. But as I'll get through in this talk, if you don't lean into it, I think that there can be some very deleterious effects on your business. So let's keep going then. The reason why the SME owner, by leaning in, they can then have a truly integrated approach to leading their business. So for instance, a lot of people, if you look at a lot of corporations over the years that do some really, really strange things with terminating people in busts and doing all sorts of different and strange things. And it's obvious, it's often because the left hand doesn't know what the right hand's doing. And in an SME, the opportunity here is that we can integrate across these. So your financial security needs to be well informed by your culture. And so healthy culture in our 4 zones and financial security are 100% integrated. There can't be, you can't actually have an action in financial security that breaks your values. So I'm going to give you, I'm just going to read these out. These will be in the presentation when you receive it later today, but I'm going to read these out. And these are all things that are questions that really prompt how culture and financial security overlay so much, right? So how much money do you take out today versus a rainy day? How much money do we reinvest? If there is a downturn, how do we reduce expenditure? How transparent will we be with our team on financials? What will our terms and conditions be to our customers? How will we pay suppliers? What terms? How will we pay our people? How much will we pay ourselves, leaders, owners? Will we recognize our real costs to the business? The reason I share that one is that a lot of SMEs don't actually put the real cost of their salary into the business because they're trying to do tax optimization to get it as a dividend. What I do is I explain to them that if they're going to try and build succession for them out of the business and they haven't put in that real cost, then at a point in the future, they've almost got a false economy. Will we recognize, sorry, the real cost one, how many owner perks will we implement? Will they create problems in the future? Now, I can only state that because I had owner perks. Now, owner perks are things like, okay, I'll get the business to pay for my car. These are going back years and years, you know, and we just found that these are all horrible things that you have to unravel if you want to build a resilient business. And what you want to do is you want to try, well, in our values code, we made the decision that we didn't want any privilege so that yes, there's different salaries, but that's the only differentiator. Now, I'm going to give a big tip here, which I think directly relates to purpose and values, right? And that is, and this is a topic that could be a webinar all of its own. And it's about delayed gratification. And I believe that delayed gratification is critical to resilience thinking. So what is delayed gratification? So let's say that your business is profitable and you can make the decision. Now, a lot of SME owners, I think, are actually on the conservative side of this, and they do delayed gratification, but others don't, and it will have a big impact on them. So when I make a profit, what do I do with those profits? So how much do I take out now, and how much do I reinvest, and how much do I put into a future fund, and how much? So these are the sorts of things to consider when you're thinking about financial security and resilience. But I just want to make this point about the integration with healthy culture. Okay, so this question here of working capital, I get these are very, very, very big topics, and there's so much to them. But I think this is one of the areas that a lot of startups make a really big mistake early on. So they often will say, okay, I want to get funding into my business, and the way that I'm going to do it is I'm going to bias to equity, and I'm going to try and attract investors, but they often make the mistake of doing it too early in the life of their business, and they also don't lean into alignment with the investor, so they don't realize that the aspirations of the investor and their aspirations are different, which causes grief and problems. And the other thing is that I've noted that if you look at a lot of venture capital type companies, they don't have the pursuit of revenue early in the life of the organization as much because they're utilizing the equity. And I think that as my advice to SMEs is, as much as possible, try and bootstrap your revenue as fast as you can. But anyway, let's move on though, because I'm not talking about startups here. I want to talk about revenue, debt, equity to manage working capital. In 2009, the GFC hit. We had a line of credit facility of $2 million. We had $500,000 in our future fund. So we had effectively $1.2 million in cash, but our burn rate at that particular time was about $1 million a month. It was pretty, so we had about $1 million in cash. Now that was not good. We didn't like having that little amount of cash, especially because we're in a GFC and we don't know when it's going to finish. So what we did was we said, okay, we don't want that to happen again. And so we put a bunch of things in place, and I'm going to talk about this in a moment when I talk about forecasting. But I do want to say that this is what really drove us to build a future fund. And I will just tell a quick story about the future fund idea. And this is just a rainy day account. So we literally set up a bank account that had cash in it it had a valve on it. And I, as managing director, was the only one that would allow money to come out. and I called it a monodirectional valve. So we really wanted that to be left alone for the really, really needy times. Now, how did we get money into it? Well, when we did a profit distribution, this is how we did it. This was pretty much our stock standard way of distributing a profit. 20% went back to our employees. In 1 or 2 years, over and above the operating expense that went to community groups, we also put another 2% to community groups. We had an internal group called Community Connect that did all that. Then we paid our tax. Then 50% went to our future fund and 50% went to dividend return. Now that policy, that approach was really, really effective. And so I really recommend that as a way of topping up your future fund. So at the time that we sold, Acquire in 2018, our future fund was equivalent to about 15% of revenue and was quite a healthy sum of money. So we didn't actually have to tap it in the life of the company, but it meant that we were very, very resilient. It meant that in 2012, when the downturn came, we had 50% of our revenue in cash. So consequently, the 2012 downturn went for 5 years, and we were able to navigate that because of the way we'd managed cash. So this thing about working capital, I mean, cash is king, and cash is king. I mean, you'll hear that from every business advisor ever. And you can't, I don't think you can put too much time into this particular area. So we were employee owned, so the equity side was all inside the walls. So you had to be an employee to be an owner. And then we had a $2 million line of credit facility, which our securitization for that was a building that the company owned. And then we had revenue. So let's keep moving. So how do you have forecasting solutions that support good decision making? Well, this is a massive, massive topic. And I can honestly say that I didn't think that I would get into forecasting I reckon I could, for any business, it's so bespoke. How you do forecasting in one company is going to be vastly different to how you do forecasting in another company. But I think the story I'm going to tell will actually give you a bit of an insight into how Acquire did it. And I've simply taken those ideas over into Adapt, But Adapt's life at the moment is we're a startup, so it's quite simple. Whereas in Acquire, we had quite a complex problem. So what we realized is that based on 2009 and the GFC, and not really being able to have enough foresight about our business, we know that we're always, when we're dealing with forecasts, we're always dealing with trying to optimize guessing as much as we possibly can, right? So nobody has a crystal ball, but what we ended up doing was we set up a blue team, and then we set up a red team. Now, nobody really liked the color red for a team that's going to come in, because I'll tell you what that team did. So we ended up calling it the green team. So we had a blue team and a green team. The blue team ran the flywheel of our business. And what they were responsible for was reforecasting the business 12 times a year. We broke up our business into 12 sprints. And each sprint, their job was to integrate the pipeline from the economic engine with the actuals and say, okay, on the basis of that data, what is our P&L forecast going to be? Our profit and loss forecast going to be? And they would do 12 sprints. Now, what we started off just doing revenue, because expenditure is more demanding to run around the business. I mean, forecasting is so difficult to do because you don't understanding your pipeline is very, very difficult. But expenditure, there's just a lot of footwork to get it done. In the end, we did forecasting of both revenue and expenditure every month. And this proved to be vital to the downturn that came in 2012. And the reason why it became vital is because we were able to see the collapse of the pipeline, and we were looking forward, not looking at historic financials. Because if you look at historical financials, the problem's already hit you. So we were able to make decisions. So what happened is we had 3 sprints in a row where the blue team said that the forecast is dropping. We immediately, that then triggers the green team. The green team has met previously and has engaged its purple brain to actually say, well, what are the things that we're going to do if the blue team call us in? And so we would do things like, okay, we're going to freeze the hiring plan so no one else can get hired. And the green team would do this. And the green team has the highest authority in the business, if you like. That's like the board, if you like. What expenditure would be reduced if the situation got to a different situation, right? If we're going to reduce salaries, are we going to do it by selected people? Or do our values declare that we have to have one reduction for everyone, right? Or do we say the leaders take the haircut first and then the rest of the team? All those sorts of things, we made the decision to do that prior. So the green team made that decision prior, and then when it gets called, it just means we can be calmer in the way that we implement our decision making. And I think it was a really cool idea that those responsible for actually doing the hard work of managing the forecasting were not then having to make the decisions about what to do to maximize the resilience of the business. So I think I'm going to raise something here, and this is just a tip. And you know, I'll give you this tip, but for me, I talk to SME owners all the time about the wonderment of promoting transparency of your financials. If everybody understands, now that doesn't mean you have to share everybody's salary. I would share my own, but it doesn't mean everybody has to share salaries, but if everybody understands the profit and loss, the income and expenditure, and truly understand it, that means that if you do need to pull your belt in, tighten your belt, then everyone can contribute. At another time, there is a story about the CARS project. You know, it was commercial awareness reduction. Anyway, I can't remember what the acronym stood for, but the CARS project was where we set up, every regional team was tasked with what could we do to reduce our expenditure, and it was extraordinary. I wasn't actually a leader at that time. That was after 2014, and it was really a very good story about what everybody did to pitch in and actually do to tighten the belt with expenditure. Okay, so let's move on now. Okay, so I think that the point I want to make about this area about the collection side of the business and, you know, your management of your debtors. You know, last week I spoke about, you know, the idea of how we were able to get from 75 days to 42 days. And that came about because I went out with the operations leader, value stream leader, and Woz and I went out for lunch, and I said, you know, what's really, you know, your biggest challenge right now? And he said, our terms. We've got two, I won't say which company, but this company is a very, very well-known Australian mining company, had just released an extraordinary interim profit report. And we had two of their operations that were over 100 days in payment of a significant amount of money to us. And so we're at that time, our average collection days. So this is days where from the point of invoicing, right, to getting the funds paid, I mean, it's extraordinarily unethical. Our terms, we tried to stick to our 14 days payment terms to our creditors, and here we were getting 75 days from some of the largest resources companies in the world, which I think was totally unethical. But anyway, so what we ended up doing was putting a lot of work into getting it from 75 to 42 days. And when you think about it, 42 days is still that seems very unacceptable. If I was in their businesses, because of my empathy for the SME, I would run around their business and bring that way down. Anyway, the part that I started to learn, though, is that we had more control of that problem than we thought. And so if you look at a standard sort of flow, in the value stream, you propose and get the signature, and then that's often where there's an intersection between the value stream and the economic engine and the financial team, and they invoice and collect. Now, we found that at every one of these places, like the BD teams would often think, oh, my job is done at sign. And this is what we learned. Well, no, it's not done, because if the money doesn't get to our bank account for 100 days, then we end up being a bank for that corporation. So we just ended up building these practices to actually say, okay, how can we actually reduce the time between the time we propose to the time we collect? I don't have the time today to go through all of those sorts of things, but I think that just to be conscious of this is the first thing, and then you can put in processes to optimize each part. The other thing is that there's a real overlap with your business model. So for instance, in services companies, I think most services companies now operate on a third or 50-50, invoice 50% on signing and then 50% on delivery. But these are really important things, because if you can have an extraordinary amount of time from signing to invoicing. So that period between signing and invoicing is something that you've got control over. So if there's waste in your own system between signing and invoicing, that's an area to fix up as well. So given the time, we're getting up to questions and answers, but this all builds up to this idea of getting on top of, you know, numbers to run your business. You know, and look, I can't answer that. Actually, I have when I send out the slides for this, I will send out, for some reason, my financial security and ownership slides are, the financial security and ownership numbers are not present there, but I'll read them out. And when you get this presentation, they'll all be filled in. So what can these numbers be? And it's very, very different by every business, but you know, it could be in the economic engine, it's revenue by product, customer satisfaction numbers. So things like net promoter score, productivity in delivery, some metric that says how well you're delivering and how efficient and effective you are. Last week I spoke about customer risk, so you could have some customer risk ratios. In healthy culture, you've got employee satisfaction, and so you note here that I'm talking about financial security, but when it comes to the numbers that define your business, I think it's also important that the people that are actually reporting on the status of the business also are looking at it from a holistic organization perspective, not just the financial numbers, because all of these are important. So, and these are just examples. Every business, you might just have 2 or 3 of these, or you're totally different metrics, but I just think it's a really good idea to think of these things. So employee satisfaction, employee engagement, number of exits, you know, training metrics. And then on financial security and ownership, we've got things like you've got the profit and loss position, and then you've got the forecast position. You've got collection average days, you know, the how many weeks of cash you've got in your business. So there's so many different, so what we like to do is actually work with the owners to facilitate, well, what are the critical numbers that are going to work for you? And I want to raise a point here that the critical numbers, there's a set of critical numbers which you can't carry around in your head maybe, but I used to have this thing called, you know, memory metrics. So I used to have about 6 numbers that at any one time somebody could ask me those 6 metrics, and I would be able to tell them off the top of my head. And I did that because it just made me feel comfortable. But that's just a tip. I think that, so one metric for me was, okay, our revenue for this financial year is going to be 20 million, right? It's January, right? So our forecast revenue is 20 million. It's January and we're at 9 million. So then you know you've got 11 million differential to pick up in the second half of the financial year. And then you've got to say to yourself, well, where does that feel right? Anyway, look, so what I'll do is I will stop there. It's 11:47. That gives us, you know, near on 10 to 13 minutes to actually have some questions about, a bit of Q&A about all this.